All right, today we're going to break down a complete step-by-step playbook for trading one of the most notoriously volatile economic data points out there, the University of Michigan Consumer Sentiment Release. And this isn't about guesswork, okay? This is about executing a professional-grade protocol, minute by minute. But first things first, we have to talk about the most important rule in this entire system. It's called the kill zone. Think of it as a 10-minute window from 9:55 to 10:05 a.m. Eastern Time. During this period, your one and only job is to observe. Trading is absolutely 100% forbidden. Seriously, this discipline is what separates the amateurs from the pros. So how do we even approach this event? Well, we don't look at it as just some news headline. We treat it as a positioning stress test. Basically, it's designed to shake things up, challenge the existing market positions, and really reveal the true path of least resistance. Now this is the engine for the entire strategy. It's called the anchor flow, and the sequence here is absolutely critical. It all starts with treasury yields, what we call the TNX. Their movement leads the equity indices, which in turn lead the sector ETFs, and then finally individual stocks. If this chain reaction breaks at any point, the whole setup is invalid, period. This whole playbook is really built on 5 core principles. First, you've got macro awareness. You got to know the context. Second, binary legality. A setup is either good to go or it's not. There are no gray areas. Third is behavior-proof execution, which is all about taking your emotions out of the equation. Fourth, single trade discipline. And above all else, you have to respect the kill zone. Okay, let's get into the practical steps. Success doesn't just magically happen at 10 a.m. It's built in those 25 minutes leading up to the release. I'm telling you, preparation is everything. Your pre-release checklist is a really straightforward 3-step process. First, you're going to mark your key levels on the chart. Second, you check the market's structural bias to see if it's even primed to make a big move. And third, you filter for liquidity, just to make sure the market is functioning like it should be. So what are these key levels? We're not just drawing random lines here. We are marking the session highs and lows from Asia and London, the volume-weighted average price, or VWAP, and this is critical, the prior day's value area high and low. We call them VAH and VAL. These levels literally define our battlefield. All right, so you've got your levels marked. Now you have to ask yourself the single most important question before any trade. Is the market actually ready to move, or is this whole thing just going to be a lot of noise? And here is our non-negotiable filter. This is the line in the sand. We check the average true range, or ATR. If today's ATR isn't at least 80% of its 20-day average, you know what we do? We close the playbook. No trade. It's that simple. Without enough background volatility, the release just isn't likely to spark a clean, tradable move. Okay, we're prepared. Our levels are marked, volatility is confirmed. Now we enter the most critical 10 minutes of the whole event, the kill zone. This is where impatient people lose their shirts and disciplined traders preserve their capital. Your job here is to do one thing. Watch. That's it. The first rule is absolute. Under no circumstances, I mean zero, do you enter a new position during the kill zone. The price action is just chaotic, the spreads get wide, and the initial data is pure noise. Don't do it. The second rule is just as vital. Do not add to an existing position. Those first few moments right after the release, that's not confirmation. No, that's a head fake machine designed to trap you. And rule number 3 completes the trifecta of discipline. Do not try to be a hero and fade the initial spike. The market is trying to absorb the new data, and fighting that first impulse is just a recipe for disaster. Your job is to wait, let the dust settle, and see the structure become clear. And there's one more critical override to know about. We look at the very first 5-minute candle after 10 a.m. If its total range is more than 0.6% of the instrument's price, the move is just too wild, too chaotic, the setup is invalid, we just walk away. Okay, so once the kill zone passes at 10:05 a.m. and that volatility override isn't triggered, trading actually becomes possible. But look, it's not a free-for-all. It becomes a simple, binary decision based on predefined what we call legal patterns. So what are we looking for? Well, a legal setup like you see on the left is a clean price move. Maybe it sweeps a key level and then reclaims it, or it's a clear breakout that actually holds. Illegal conditions, on the right, are pretty much just chaos, messy price action, yields not confirming the move, or price just chopping around sideways. If it looks illegal, you do nothing. So after 10:05, you're pretty much going to see one of three scenarios play out. The best case is alignment. Yields lead the way, the market breaks cleanly, and you can trade for continuation. The second is a break that fails. The move just fizzles out. Here, you wait or you immediately cut your trade size in half. And the third is just flat. Nothing is moving. That's your signal to just stay out. All right, so even with a picture-perfect entry, a trade can still fail. And that's why the final layer of this whole protocol is a set of non-negotiable rules for managing the trade and, more importantly, protecting your capital. This is your circuit breaker. Your max loss for the day is 3R. R is just your initial risk, the amount you're willing to lose on this one trade. If you hit that 3R loss limit, you are done. No revenge trading. You shut it down for the day. Think of these rules as your shield. If a trade moves 2R in your favor, you move your stop to break even. You lock it in. If the price action gets choppy or unclear, you cut your size. All trades are closed before 10:30 a.m. no matter what. And finally, never ever add to a losing position and never re-enter after a failed move. The first move is the only move that matters. If you take only one thing away from this whole explainer, let it be this mantra right here. It doesn't matter if the consumer sentiment number is good or bad. What matters is how the market is structured and how it reacts. We trade the price action, not the headline. And this really brings it all together, doesn't it? Trade the structure, not the number. Remember that any move in equities is basically illegal. It's untrustworthy unless yields are leading the way. And finally, just follow the process. Observe during the chaos, confirm a legal setup, execute with precision, and manage your risk relentlessly. So, there you have it. That's the complete professional-grade protocol. You see, it's not about being right all the time. It's about being disciplined inside a proven framework. So the only question left for you is, does this level of structure actually fit your style of trading?